Happy Wednesday out there, folks. This is Darius Dale here to present our macro minute for Wednesday, May 11th, 2022. Let's just hop right into it, starting with asset markets. We got stocks up, commodities up, crypto up, dollar down, global bond yields down. This is a very clear Goldilocks signal from the marketplace ahead of the CPI data today, out at 8:30 Eastern. Inflation in China, shifting to our market-moving headlines, picked up more than expected to 2.1% in April as COVID outbreaks and lockdowns drove up food and energy costs. So we'll talk about that in the leadoff morning note in terms of China's impact on potential incremental global supply chain disruptions from here as it relates to the inflation data in the U.S., which the Fed are obviously queuing on. Shifting gears to Europe, ECB rate hike looks more probable in July after Governor Christine Lagarde joined the chorus of ECB council members, saying that the first increase may follow weeks after the end of the net bond buying early next quarter. In July, they've guided to that. So we continue to get more hawkish signals out of the ECB. In yesterday's macro scouting report, and thanks to everybody who tuned in. It's probably the best piece of research I've put out in my career. And for those of you who've been following me for a long time, know that I've put out a tremendous amount of fantastic, high quality, very, very good, bigly research ever in my career. So definitely go check that out if you had a chance to review it. But anyway, we talked about the European inflation dynamics, specifically in the context of, okay, when do we allocate to duration? What are the markers that we're looking for to give us the all clear signal that it's time to rotate in duration in terms of removing the duration risk that has continually emanated from the European continent, not just with respect to the inflation pressure, but also with respect to the reaction function out of the ECB. Shifting gears back to New York here, Coinbase down 15% pre-market after the largest U.S. cryptocurrency exchange warned of lower trading volume. We're in the wrong part of the liquidity cycle. I don't think I think you can pull up a chart of any cryptocurrency and figure out that we're in the wrong part of the liquidity cycle. So in yesterday's macro scouting report, we spent about 15, 20 or 25 slides talking about where we are in the liquidity cycle, sort of pinpointing where we might start to inflect to the positive side of things, both from a calendar perspective and also what are the catalysts and markers we need to see economically to get there. So for those of you who like to have a roadmap on when do you buy, when do you start to increase your allocations from cash or from Tether into different cryptocurrency pockets of cryptocurrency markets, what types of risks you should be taking. We really explain that as well. So go check that out. It's better to spend $100 on the macro scouting report than it is to lose $100 in the cryptocurrency space. Shifting gears, econ calendar, we got the PPI data tomorrow or today, or CPI data today, PPI data tomorrow. Mary Daly, who is traditionally a drug, but she's kind of been roped into the hawkish camp. She's talking tomorrow as well. University of Michigan consumer sentiment, we'll get that on Friday as well. Big movers in the market. We got WTI crude oil up 4% to up 6% month over month. So nice little rebound there. Silver, big rebound after we flagged that and lead off morning note in our crowding analysis is a good way to play a WCPI print. That's up 2% today, minus 13% month over month. And then you got a real Goldilocks move on the long end of the Treasury curve this morning. 10-year nominal and real yields both off 6 basis points apiece, which means obviously all the move in the nominal is on real. Now the 10-year nominal is up 22 basis points month over month. 10-year real yield is up 46 basis points month over month. And that's part of the reason we've seen such a violent decline in the NASDAQ as the bond market has gotten with the program as it relates to the outlook for Federal Reserve tightening. Shifting gears to our volatility adjusted momentum signal and probable range analyses, U.S. dollar index or Bloomberg dollar index, right? That's a much better index for those of you who are still stuck on the DXY. We're not sure why. That's a nice little rhyme there, Sunny D. Minus 1.4% of downside, the lower boundary of its probable range with 1.6% of upside. Gold neutral VAMs bounced off the lower boundary of its probable range, minus 1.4% of downside versus 4.9% of upside. This is a chart that is clearly breaking down, in our opinion. It's just struggling. 10-year nominal Treasury yield bullish VAMs. Minus 12 basis points of downside versus 37 basis points of upside. So much more upside than downside there in gold. High yield OES bullish VAMs bounced off the upper boundary of its probable range with minus 45 basis points of downside and 38 basis points of upside. The S&P 500, that is bearish VAMs, a little bounce here. Minus 6% of downside versus 6.3% of upside. So that's a fair fight there. VIX, a little less of a fair fight, minus 35% of downside versus 23% of upside. Volatility, as I talked about yesterday, is really underperforming in this. It had underperformed in this market decline, which tells you that the fear out there isn't as palpable, which means it's very unlikely we see sort of a capitulatory event that could both cause investors to really see some very attractive valuations, but also cause the Fed to really get engaged in terms of a pivot. And this is the worst kind of bear market, is the bear market where you don't get the dovish pivot soon enough. And so I just want to reiterate that. The underperformance of volatility is a clear signal that hedge funds, active managers have taken down their book size, they've taken down their gross exposure, and so they don't need to be as hedged. They don't need as much demand for volatility products. But it does mean that the passive investors, of which there are many, continue to be very slow moving and reactive to this market decline. We expect more of the same until we get that dovish pivot. Nasdaq 100 bearish, VAMs minus 8.2% of downside versus 7.8% of upside, so a fair fight there. Russell 2000 minus 5.8% of downside versus 8.9% of upside, so a little more upside than downside in the Russell there. Bitcoin still bearish, VAMs bounced off the lower boundary of its probable range a little bit, still minus 3% of downside versus 21% of upside. Ethereum bearish, VAM still minus 9% of downside versus 18% of upside. Nice little very dead cat bounce off the lower boundary of the probable range there as well. Shanghai Composite getting near oversold, minus 9.4% of downside versus 1% of upside. WTI crude oil neutral, VAMs minus fair fight, 10% of downside, 10% of upside. Ag bouncing out the lower boundary of its probable range, minus 1.8% of downside versus 4.3% of upside. Still neutral VAMs there. Industrial metals still neutral VAMs. Again, I mentioned we talked about this the last few days, going back to last week. The demand destruction we're seeing in the industrial metal complex, minus 2.9% of downside versus 12.9% of upside. Definitely watch this closely as China starts to reopen its economy to see if we actually get a real signal across global financial markets that China's ready and willing to reflate us out of this mess. We continue to suggest that they aren't. Talked about that in great detail in our macro scouting report yesterday as well. So go check that out. Don't be a cheapskate. Be someone who manages risk appropriately. Have a great day.